Numbers have a way of cutting through denial. They don't argue, they don't spin, and they don't care how uncomfortable the truth feels. As of today, January 19th, 2026, more than 1 in 4 Americans, 27%, have no emergency savings at all. Not a few $100s, not loose change, nothing. No financial buffer of any kind. It gets worse. Nearly 6 out of 10 Americans, 59%, would be unable to handle a $1,000 emergency without borrowing money. That means a single medical bill, a car repair, or a missed paycheck is enough to push the majority of households into debt. At the same time, the personal savings rate has fallen to just 4.4%, the lowest level seen in modern economic history. While television panels debate politics and social feeds overflow with vacation photos and lifestyle highlights, something far more serious is unfolding quietly across the country. The American middle class is being dismantled, not by a single event, but by structural forces most people don't even realize are in motion. This is not a warning about some distant future. This is already happening. It's happening at kitchen tables in Ohio, in checking accounts in Texas, and inside retirement portfolios that took decades to build and barely a year and a half to shrink. Families who did everything they were told, worked hard, saved consistently, followed the rules, are watching their financial stability erode in real time. When the pieces are laid out in sequence, the picture becomes impossible to ignore. The $38.43 trillion national debt, the 9.1% decline in the dollar during 2025, the rollout of alternative global payment systems scheduled for 2027. These are not isolated developments. They are connected, and once you see how they fit together, the conclusion is not dramatic. It's mathematical. This isn't exaggeration. It isn't fear-mongering. It's arithmetic. Cold, unforgiving arithmetic that shows what happens when a system built on debt, currency dilution, and false stability finally runs into reality. If your wealth is held entirely in dollars, if you're relying on institutions to protect your purchasing power, if you're waiting for someone else to fix this, you are already behind the curve. Here's a question that deserves serious thought. How many paychecks stand between you and financial disaster? For 53% of Americans, the answer is 2. Half the country is living with no margin for error, no backup plan, no safety net, one medical emergency, one unexpected repair, one job loss. That's all it takes. This vulnerability isn't limited to lower income households. Nearly 1/3 of Americans earning more than $100,000 a year are also living paycheck to paycheck. 6-figure incomes, yet no meaningful savings. The reason isn't reckless spending. It's that living costs are rising faster than earnings. Housing has moved out of reach for millions. Everyday necessities consume a larger share of income each year. Meanwhile, the purchasing power of the dollar continues to decline, even as official messaging insists everything is under control. The Federal Reserve reports inflation at around 3%, but that number doesn't reflect lived reality. Grocery receipts tell a different story. Rent increases tell a different story. Insurance premiums tell a different story. The inflation people actually experience, the cost of food, shelter, transportation, and healthcare, is running closer to 8 to 12% annually. That means even if your income is rising, your money is losing value faster than you can replace it, and this is only the surface of the problem. To understand why household finances are under such extreme pressure, you have to look beyond individual choices and examine what's happening at the federal level. This is where the structure supporting the entire system begins to fail. The United States national debt has now exceeded $38.43 trillion. It's a number so large that it barely registers emotionally anymore, which is part of the danger. When figures grow beyond everyday comprehension, people stop reacting to them. But scale matters, and this one is overwhelming. The debt isn't increasing gradually, it's accelerating. The federal government is adding roughly $8.3 billion every single day. That's not a monthly figure, it's daily. Broken down further, that equals about $334 million per hour, $557 million per minute, and just over $92,000 every second. Every moment that passes, more money is borrowed that has no realistic path to repayment. What makes this situation even more fragile is how much it now costs just to service existing obligations. Annual interest payments on the debt have reached approximately $1.22 trillion. That spending doesn't fund infrastructure, healthcare, education, or national security. It pays nothing new. It simply covers the cost of past borrowing. Interest alone now consumes nearly 14% of the entire federal budget, and that share is still climbing. Projections show that by 2028, interest payments will take up an even larger portion of government spending. As that happens, less funding is available for everything else: Social Security, Medicare, veterans benefits, and other programs people depend on. The growth rate of the debt tells an even clearer story. In January 2025, total federal debt stood at roughly $36.18 trillion. 1 year later, it had jumped to $38.43 trillion, an increase of more than $225 trillion in just 12 months. According to Congressional Budget Office projections, the total will approach $41 trillion by 2027 and move toward $50 trillion by the end of the decade. This is not a temporary imbalance. It's a debt spiral, one that occurs when a government can no longer fund itself through taxation and must rely increasingly on borrowing simply to maintain operations. There's a reality few officials are willing to state openly. This debt cannot be repaid in real terms, not through spending cuts, not through higher taxes, and not through economic growth. The numbers don't support it. The only remaining mechanism is currency dilution, reducing the real value of the debt by weakening the currency itself. When that happens, the burden doesn't disappear. It's transferred. Savings lose purchasing power. Wages fall behind prices. Retirement accounts shrink in real terms. The cost of government borrowing is paid by citizens through inflation. This dynamic is already visible in household finances. Roughly 27% of Americans now have no emergency savings at all. That's nearly 90 million adults with no financial buffer. The reason isn't widespread irresponsibility. It's that rising prices leave little room to save. About 73% of Americans report saving less specifically because of inflation. Debt fills the gap. The average American carrying credit card balances now owes about $7,321, often at interest rates exceeding 22%. Rates like that would have been considered predatory not long ago. Today, they're standard. At the same time, total household debt, including mortgages, student loans, auto loans, and revolving credit, has reached $18.59 trillion. The portion of disposable income going toward debt payments sits at roughly 11.2%, a figure that understates the strain because disposable income itself has been eroded by higher living costs. For many households, the math no longer works. Incomes stagnate while housing, food, energy, and insurance costs climb. That leaves families one unexpected expense away from missed payments. When enough defaults occur at once on credit cards, auto loans, and mortgages, the stress moves from households into the banking system. This is how financial crises cascade, and unlike 2008, there is limited capacity for large-scale rescue. Since 2020, the Federal Reserve has already created trillions in new money to stabilize markets. Repeating that process at the same scale risks destabilizing the currency itself, which brings us to the most critical variable in the entire system, the dollar. Everything in the current financial system ultimately rests on the strength of the US dollar. When that foundation weakens, pressure spreads everywhere into prices, wages, savings, and debt. Over the past year, that weakness has become increasingly visible. In 2025, the dollar lost 9.1% of its value against a basket of major global currencies. That marked its worst annual performance since 2017. The US dollar index, which tracks the currency against the euro, yen, pound, and others, fell from around 109 in early 2025 to approximately 99.8 by January 2026. Forecasts now suggest further declines, with projections pointing toward the mid-90s range in the near term. This isn't happening in isolation. One of the main drivers is interest rate policy. As the Federal Reserve moves toward cutting rates, returns on dollar-denominated assets fall. Lower yields make holding dollars less attractive to foreign investors, who then reallocate into other currencies, commodities, or hard assets. As demand for dollars decreases, the currency weakens further. Under normal circumstances, currency cycles fluctuate. But what's unfolding now is not a typical cycle. It's a structural shift. For decades, the dollar benefited from a unique position as the world's primary reserve currency. Governments held dollar reserves. Global trade was settled in dollars. Key commodities, from oil to food to industrial metals, were priced in dollars. This created constant artificial demand that supported the currency even as the United States ran persistent deficits. That system is now breaking down. A growing coalition of countries is actively reducing its reliance on the dollar. At the center of this shift is BRICS: Brazil, Russia, India, China, South Africa, along with additional member states including Saudi Arabia, the United Arab Emirates, Egypt, Ethiopia, and Iran. Together, these nations represent nearly half of the world's population and more than 1/3 of global economic output. These countries are not talking about change in abstract terms. They are implementing it. A new payment infrastructure, often referred to as BRICS Pay, is already operational, linking Russia's SPFS system, China's CIPS network, and India's UPI into a unified settlement framework. Trade between major BRICS economies is increasingly settled in local currencies rather than dollars. Russia and China now conduct the vast majority of their bilateral trade in rubles and yuan. Brazil and China have removed the dollar from large portions of their trade relationship. India has purchased energy supplies using rupees instead of dollars. These are not pilot experiments. They are active, ongoing transactions involving billions in trade volume. In late 2025, BRICS nations also reduced their exposure to U.S. government debt, selling tens of billions of dollars in treasury holdings while increasing gold reserves. Collectively, BRICS central banks now control thousands of tons of gold and have signaled intentions to continue increasing those reserves. At the same time, a new digital settlement instrument, referred to as the unit, has entered limited use for cross-border trade within the BRICS framework. Backed partly by gold and partly by member state currencies, it allows international settlement without touching the dollar or traditional Western banking rails. Early transactions are already being processed. The implications of this shift are profound. When countries no longer need dollars to trade with one another, demand for the currency falls. When demand falls, the value of the dollar declines. And because the United States imports a significant portion of what it consumes, a weaker dollar directly translates into higher prices at home. Energy, food, electronics, pharmaceuticals, most essentials rely on global supply chains. If foreign suppliers no longer want to be paid in dollars, the U.S. must first exchange its currency for alternatives, placing additional downward pressure on the dollar in the process. That dynamic feeds on itself. This is how currency erosion becomes a self-reinforcing loop, and this is why the timing matters. By early 2026, the warning signs are no longer abstract. They are measurable, visible, and accelerating. At the start of the year, the dollar sits just under 100 on the index. Alternative payment systems are no longer theoretical. Household savings are depleted. Debt levels, public and private, are at historic highs. The federal government is borrowing billions each day simply to function. As 2026 progresses, the Federal Reserve continues easing monetary policy in an attempt to avoid recession. Rate cuts, however, come at a cost. With each reduction, the dollar loses further support. By the end of the first quarter, the dollar index drifts into the mid-90s range. Within the BRICS bloc, trade settled in local currencies expands rapidly, accounting for the majority of intragroup commerce. Major energy exporters announce a growing willingness to accept non-dollar payments for oil and gas. This quietly removes hundreds of billions of dollars in annual global demand for U.S. currency, demand that once formed the backbone of the dollar's dominance. By mid-2026, the effects begin to show up more clearly in domestic prices. Inflation, which had appeared to cool, starts moving higher again, not because of overheating demand, but because imports cost more when the currency weakens. This places policymakers in a bind. Raising rates to defend the dollar risks stalling economic activity. Cutting rates supports growth in the short term, but accelerates currency depreciation. The choice consistently favors short-term stability. As the year continues, the dollar slips further. Alternative settlement systems expand beyond pilot programs and into broader commercial use. Global trade increasingly bypasses traditional dollar-based channels. U.S. businesses face higher input costs, which they pass on to consumers. Wage growth lags behind price increases, compressing household purchasing power even more. By late 2026, financial stress becomes harder to contain. A growing share of households have exhausted savings. Delinquency rates on consumer credit and auto loans begin to climb. Regional banks report rising losses as borrowers fall behind. Emergency liquidity measures are introduced, but they address symptoms rather than causes. Entering 2027, conditions deteriorate rapidly. The dollar weakens further as capital flows seek alternatives perceived as more stable. New bond issuance requires higher yields to attract buyers, increasing the government's interest burden. Demand for U.S. debt softens as foreign buyers step back. At the same time, alternative settlement currencies expand beyond government-level transactions. Businesses and financial institutions in participating countries gain broader access, allowing them to hold and transact outside the dollar system directly. This marks a turning point, the emergence of credible competition. As confidence erodes, capital preservation becomes the priority. Investors seek assets that cannot be diluted: commodities, precious metals, real assets, and foreign currencies. The Treasury increasingly relies on the central bank to absorb new debt issuance, effectively monetizing deficits. This transition carries consequences. When money creation is used to fund government operations at scale, inflation accelerates. By mid-2027, official inflation readings rise sharply. Real-world cost increases outpace outpace reported figures, especially for necessities like housing, food, and energy. Employment conditions weaken as businesses struggle to manage rising costs and shrinking margins. Layoffs increase. Household stress intensifies. A growing share of the population is forced to liquidate long-term savings to cover everyday expenses. By the second half of 2027, the cumulative impact is undeniable. The dollar has lost a significant portion of its purchasing power in a short period. Savings accumulated over decades by far less than they once did. Debt obligations remain fixed while incomes fail to keep pace. This is the phase where financial instability transitions from concern to lived experience. What's unfolding now may feel unprecedented, but history tells a different story. Monetary systems built on fiat currency, money backed only by government decree, have followed remarkably similar paths across civilizations. The names change. The technology evolves. The outcome does not. A clear example comes from ancient Rome. The Roman economy relied on the silver denarius, a coin that once held intrinsic value. In the first century, the denarius was composed of more than 90% silver. It was trusted, stable, and widely accepted across the empire. As military spending expanded and political pressures grew, Rome faced a familiar problem. Expenses outpaced revenue. Instead of cutting costs or raising taxes to politically unsustainable levels, the state chose a quieter option: currency debasement. Over time, silver content was reduced and replaced with cheaper metals. By the 3rd century, the denarius contained almost no silver at all. It looked the same, but its value had collapsed. Prices rose sharply, savings lost meaning, trade increasingly reverted to barter. Soldiers demanded payment in land or gold rather than coin. Once confidence in the currency vanished, the economic foundation of the empire collapsed, ushering in centuries of instability. The mechanism was not unique to Rome. Similar patterns appeared in Weimar Germany, Zimbabwe, Venezuela, and countless other cases. Governments overspend, deficits grow, currency issuance accelerates, purchasing power erodes, inflation transfers wealth from savers to debtors and from the public to the state. The modern U.S. system follows the same structure, though with digital money instead of metal coins. Until 1971, the dollar was linked to gold. When that link was severed, the currency became fully fiat. Since then, the dollar has lost the vast majority of its purchasing power, not suddenly, but steadily. What replaced gold backing was trust. Trust that the government would manage spending responsibly, trust that deficits would remain manageable, trust that the currency would retain value over time. The trust is now under strain. When a government borrows at increasing rates and relies on money creation to fund operations, the currency absorbs the damage. It happens gradually at first, then all at once. The public doesn't react immediately because prices don't rise evenly. Essentials become more expensive before discretionary items. Asset prices inflate before wages adjust. By the time the effects are widely acknowledged, options are limited. This is why attempts to fix the problem through policy adjustments rarely succeed. Balancing the budget at this stage would require either massive spending cuts or dramatic tax increases. Both options would trigger immediate economic contraction. Neither is politically viable. As a result, the path of least resistance becomes currency dilution. Inflation functions as a hidden tax. It reduces the real value of government debt while quietly transferring costs to the public. Savings decline in real terms. Fixed incomes lose ground. Long-term financial planning becomes unreliable. History shows that once this phase begins, reversal is extremely difficult without systemic reset. Monetary credibility, once lost, is rarely restored under the same framework. This brings us to the question of impact, not at the national level, but at the individual level. The figure of 85% isn't a rhetorical device. It comes directly from how wealth is currently distributed. When inflation accelerates and currency value erodes, outcomes are determined less by effort and more by positioning. At present, the bottom half of Americans collectively hold only a tiny fraction of total national wealth. Many have no meaningful assets at all, just income that arrives, gets spent, and disappears. When inflation rises sharply, this group is immediately affected. They had little margin to begin with, and higher prices push them into constant financial triage. The next segment, the The middle class faces a different but equally destructive challenge. They may have savings, retirement accounts, or home equity on paper, but much of that wealth is denominated in dollars or tied to assets that struggle to keep pace with real inflation. When purchasing power declines faster than returns grow, the numbers look stable while real value vanishes. Debt compounds the problem. Loans do not adjust downward when currency weakens. Mortgages, student loans, and consumer credit remain fixed in nominal terms while wages lag behind rising costs. This imbalance erodes financial resilience month by month. Only a small minority, those holding assets that retain value independent of currency, are positioned to preserve purchasing power. Historically, this group is the exception, not the rule. This dynamic explains why periods of high inflation produce large-scale wealth transfers. The process doesn't require new laws or overt confiscation. It happens quietly through price increases and currency dilution. Those without inflation-resistant assets see their economic footing erode even if they continue working and saving. Evidence of this shift is already visible. In recent years, high-net-worth individuals have increasingly diversified internationally, relocating capital and residency to jurisdictions perceived as more stable. This movement reflects preparation, not panic. Those with access to financial advisory networks tend to act early. Most people don't have that flexibility. They rely on wages, domestic savings vehicles, and systems designed for stability rather than disruption. When those systems falter, adjustment is difficult. Understanding this context clarifies what financial loss looks like for the majority. It doesn't necessarily mean immediate homelessness or sudden collapse. It means diminished options, reduced resilience, and inability to absorb shocks, dependence on income that fails to keep pace with costs. Over time, this becomes a form of slow erosion rather than a single event. Quality of life declines incrementally. Retirement plans become uncertain. Access to healthcare and education narrows. Financial stress becomes a constant backdrop. This process rarely unfolds overnight. It advances in stages, often unnoticed, until the cumulative effect becomes undeniable. By the time large-scale financial stress becomes visible to everyone, the most effective options are usually gone. That's why understanding timing matters as much as understanding mechanics. Monetary systems rarely collapse without warning, but those warnings are often ignored because they unfold gradually, then accelerate. The coming period does not imply that society stops functioning or that everyday life suddenly disappears. It means that financial stability becomes harder to maintain for most people. Purchasing power weakens. Costs rise faster than incomes. Savings lose effectiveness as a buffer. Planning becomes increasingly short-term. It's also important to be realistic about what governments can and cannot do. In theory, budgets could be balanced through spending cuts or higher taxes. In practice, the scale required would destabilize the economy immediately. Large reductions in public spending would disrupt essential services. Significant tax increases would suppress investment and employment. These options exist on paper, but not in political reality. As a result, policymakers tend to rely on inflation as the adjustment mechanism. Currency dilution spreads the cost over time and across the population. It's less visible than direct cuts, but its effects are persistent. For individuals, this environment demands a shift in mindset. Reducing exposure to high-interest debt lowers vulnerability when prices rise. Diversifying savings away from a single currency reduces reliance on outcomes that are out of one's control. Building short-term resilience through emergency reserves of essentials and flexible income streams creates breathing room during disruptions. Increasing earning capacity also becomes more important. When inflation exceeds wage growth, standing still effectively means moving backward. Skills, adaptability, and multiple income sources provide options that static employment may not. Equally important is social capital. Financial systems can strain or fail, but relationships often determine how well people navigate uncertainty. Community, cooperation, and shared resources matter more during periods of instability than during times of abundance. None of this constitutes personalized financial advice. It's an analysis of observable trends and historical patterns. Similar dynamics have played out repeatedly across different eras and economies. The sequence, rising debt, expanding money supply, currency weakening, inflation accelerating, and wealth concentrating, is well documented. The defining question is not whether change is coming, but how prepared individuals are when it arrives. Most people delay action because disruption feels distant until it isn't. By the time responses become urgent, flexibility is limited. This is why awareness matters now, not to provoke fear, but to encourage informed decisions. Systems adjust, economies evolve. Those who understand the direction early tend to have more options than those who react late. History doesn't repeat perfectly, but it does rhyme. The patterns are visible for anyone willing to look closely. This message isn't about predicting catastrophe, it's about recognizing transition and deciding how to navigate it.